Why did mortgage rates go up when interest rates went down? The Fed cut interest rates 3 times in 2024. There was a 50 basis point, followed by 25, followed by another 25, for a full 1% rate cut in 2024. And at the same time, mortgage rates increased. And you may be wondering how that could happen. Many people I meet believe that the Fed rate affects all other rates. It does not, at least not directly.
The Federal Reserve announced its third interest rate cut of the year this week, but despite the good news for consumers, mortgage rates are still on the rise.
The Fed's rate may have an influence on certain financial aspects, but there is no direct cause and effect. So let me explain. The Fed's job is to try to keep the U.S. economy stable, to influence overall economic activity, such as inflation, unemployment, and economic growth, right? It does this by adjusting the interest rate that is used for short-term lending within the banking system. It's the interest rate that the banks lend money to each other. The Fed increases rates, or if they increase rates, it makes it more expensive for a bank to borrow money, which can slow down an economy, lower inflation, and so on. And then on the opposite side, if the Fed lowers rates, it will be less expensive for a bank to borrow money, which can help to stimulate the economy. The Fed's interest rate may have a reasonable effect on your savings rates, such as high-yield savings or money market accounts. It's because those types of accounts are liquid, which means they have a very short duration. However, the Fed does not set rates for debt instruments like treasuries and so on. The Treasury Department determines how much money it needs to borrow in order to fund the government. And then it announces an upcoming auction for its securities, right? We're talking Treasury bills, Treasury notes, and Treasury bonds. The coupon rate is the rate at which the debt security will grow. The Treasury needs to sell these securities, so it must auction them off at a competitive rate based on the current market demand. Otherwise, no one would buy them. If the Treasury sets the coupon rate too low, no one buys them. If the Treasury sets the coupon rate too high, it will result in unnecessarily high debt payments. So think Goldilocks. The coupon rate needs to be just right for them to auction them off. For example, if the market is currently trading U.S. securities with a 4.5% yield to maturity, then the Treasury will likely issue new U.S. Treasuries with a very similar rate. Various factors like inflation, economic outlook, and the current interest rates all play a factor in deciding how much people are willing to pay for new U.S. Treasuries. That's a long way to basically say market sentiment has a significant influence over the coupon rate of new U.S. Treasuries. So, where do mortgages fit into all this? Mortgages are mainly based on the rate of a 10-year Treasury, not the Fed's interest rate. In the month of December of 2024 alone, the 10-year Treasury rates grew by about 0.5 percentage point, even though at the same time the Fed had cut rates. A bank also needs to manage their risk associated with lending a large amount of money over a long period of time. If the economic outlook does not look great, and the risk of someone losing their job and not being able to pay their mortgage increases, the banks may increase their rates to compensate for the added risk. All banks increase their rates when there is more risk. Now, let's talk about the current market sentiment. Inflation is not going down as much as the Fed would like. Regardless, the Fed still lowered rates. That is a signal that we may be headed towards a more difficult economic period. If that is true, then it would make sense why mortgage rates and the 10-year Treasuries have not gone down as many would have expected. In summary, anyone can comment on the market. That doesn't mean that those who comment on the market understand how the market works. Too often people make bold claims that are not founded in economic reality. For example, many people believe that equities, stock funds, and bond funds are negatively correlated. This is not true. And many people received a harsh reality check over the past few years when stocks and bonds both went down together. Remember, there's no such thing as a perfect investment, product, or strategy. There are always trade-offs, pros and cons to be considered. Many people believe that mortgage rates are tied to the Fed. It's not totally true, just as you've learned. Now, I encourage you to never stop learning. For free information or free resources, you can visit us on financialfastlane.com, and I look forward to seeing you in the next episode of the Financial Fastlane.